In 1910, if you lived in a small town in Ohio, or Kansas, or Georgia, you could walk into a bank that was owned by someone who knew your name. You could sit across from a man who had watched you grow up, who knew your father, who understood what the soil on your land was worth and what a bad harvest year looked like. That banker made decisions based on local knowledge. He knew which farmers were responsible. He knew which merchants had good credit because he bought goods from them himself. The money he lent out came from deposits made by your neighbors, and when he earned profit, that profit stayed in the county. It circulated. It multiplied locally. It built the town around you. By 1930, that bank was gone, and the bank that replaced it did not know your name. What happened between 1910 and 1930 is one of the most consequential and least discussed financial transformations in the history of the modern world. It did not happen by accident. It did not happen because small banks were inefficient or because the free market naturally selected for consolidation. It happened because a specific group of men, meeting in secret on a private island off the coast of Georgia, wrote a document that would systematically dismantle the most decentralized banking network the world had ever seen and replace it with a centralized system that concentrated financial power in the hands of a few interconnected families and institutions. And almost nobody taught you this in school. If you are new here, this channel exists to ask the questions that do not appear in standard textbooks. We look at the documented record, the primary sources, the meeting minutes, the congressional testimony, the financial data, and we ask why certain events are framed one way when the evidence points another direction entirely. Today we are going inside one of the most deliberately obscured chapters of American economic history. Stay with me, because by the end of this, the world you think you understand is going to look very different. Before we go further, if this kind of history interests you, hit subscribe right now. We cover suppressed economic history, hidden institutional structures, and the documented paper trail of power on this channel every week. If you want to be here when the next one drops, subscribe and turn on notifications. Now let us go back to a time when America had something the financial establishment has spent a century trying to make you forget existed. The year is 1800. The United States is a young country, and its banking system reflects its political philosophy. The founders were deeply suspicious of centralized financial power. They had just fought a revolution against a crown that used economic control as a tool of political domination, and they had no intention of recreating that system on American soil. Thomas Jefferson was particularly vocal about this. He believed that private banking institutions were more dangerous to liberty than standing armies. He believed that if the American people ever allowed a private bank to control the issuance of currency, the banks and corporations that would grow up around them would deprive the people of their property until their children would wake up homeless on the continent their fathers conquered. Those words are not speculation, they are documented. Jefferson wrote them. And for the first century of American history, the banking system was structured in a way that took that warning seriously. What existed in America before 1913 was not a perfect system. No system is perfect, but it was something extraordinary by the standards of any era. It was a network of thousands of independent, locally chartered banks spread across every county in nearly every state in the Union. These were not branches of a national institution. They were independent entities. They answered to state regulators, not to a central authority. They issued their own notes in some cases. They made their own lending decisions. Their success or failure depended entirely on the quality of those decisions and the health of the local economy they served. In 1850, there were approximately 800 banks operating in the United States. By 1900, that number had grown to over 13,000. By 1910, it was approaching 25,000. Think about what that means in practical terms. 25,000 independent banking institutions operating across a country of about 92 million people. That is roughly one bank for every 3,680 Americans. In agricultural counties, in small manufacturing towns, in frontier settlements, in established port cities, there was almost always a locally owned and locally operated financial institution within a reasonable distance. This system had real consequences for how money moved. When a farmer in Indiana needed a loan to buy seed in spring, he went to his local bank. The loan officer was often also a farmer, or the son of a farmer, or a man who owned land in the same county. He understood seasonal cash flow. He understood crop cycles. He understood that a drought year did not mean a farmer was a bad borrower. He could make decisions that a distant bureaucrat reviewing a file in New York City could never make. And when times were good, the profits from those loans stayed in Indiana. They were deposited back into the local bank by the borrower once the harvest came in. That money funded the next farmer, and the next merchant, and the next family that needed a mortgage. This is what economists call a multiplier effect operating at the local level. Every dollar that circulated within a self-contained local economy generated economic activity multiple times before it left the county. The local bank was the engine that made that circulation possible. And then someone decided that engine needed to be replaced. To understand what happened, you need to understand the political climate of the late 19th century. The period from roughly 1870 to 1910 is called the Gilded Age, and it gets that name for a reason. It was a period of extraordinary wealth concentration at the top of American society. Men like John D. Rockefeller, Andrew Carnegie, J.P. Morgan, and a handful of others accumulated fortunes that, adjusted for the size of the economy, exceeded anything seen before or since in American history. Rockefeller's Standard Oil at its peak controlled somewhere between 90 and 95% of oil refining in the United States. Carnegie Steel dominated the steel industry. Morgan's financial empire touched railroads, steel, banking, insurance, and utilities simultaneously. These men were not simply successful businessmen. They were operating at a scale that made them effectively sovereign powers within the American economy. And they had a problem. The problem was the 25,000 independent banks. Those banks did not follow instructions from Wall Street. They did not need to coordinate with Morgan's financial network. They made local decisions based on local information, and that meant the great industrial empires could not fully control the credit supply. A farmer in Kansas, who got a loan from his local bank to purchase land that a railroad company wanted, was not a farmer that Morgan could easily pressure. The local bank had its own interests, and those interests were tied to the local community, not to the financial networks of the Northeast. The decentralized banking system was, in effect, a structural limit on the concentration of financial power, and the men who were accumulating that power understood it clearly. The first attempt to change the system came in the form of the National Banking Acts of 1863 and 1864, passed during the Civil War. These acts created a new category of nationally chartered banks that operated under federal rather than state oversight. They allowed national banks to issue a standardized national currency, the greenback, and they imposed a 10% tax on notes issued by state-chartered banks, which effectively made state banknotes uneconomical. This did not eliminate state banks, but it created a two-tier system with a federally supervised layer sitting above the existing local network. The architects of this system were not entirely wrong in their instinct that some standardization was useful. A country in the middle of a civil war needed financial coherence. But the National Banking Acts also had the effect of concentrating national bank charters in the Northeast, and particularly in New York City, where the major reserve banks were located. Banks in other parts of the country were required to keep reserves with designated reserve city banks, and those reserve city banks kept their reserves with the central reserve city banks in New York. Money flowed upward, toward New York, structurally and by design. This created what historians call the pyramiding of reserves. Small rural banks kept reserves with larger regional banks. Regional banks kept reserves with New York banks. In practice, this meant that the agricultural credit available to farmers in the South and Midwest was partially dependent on whether New York bankers decided to release those reserves. And New York bankers had their own interests, their own crises, and their own priorities. When financial panics hit Wall Street, as they did in 1873, in 1893, and most dramatically in 1907, the consequences rippled outward to every county bank in America because the reserve system connected them all to the same pressure point. The Panic of 1907 is the key moment. It is the crisis that was used to justify everything that came after it. In October of 1907, a speculative scheme involving the copper market collapsed. The Knickerbocker Trust Company, a major New York financial institution, was exposed as having participated in the scheme. Depositors began withdrawing funds. The panic spread to other trust companies and banks. Credit markets seized. Stock prices collapsed. The crisis was severe, and it was real, but the response to it was shaped by men who saw in it an opportunity. J.P. Morgan, then 70 years old and the most powerful private banker in the world, personally organized the response to the Panic of 1907. He convened meetings in his private library. He decided which institutions would be saved and which would be allowed to fail. He coordinated the infusion of private capital into the system. He effectively acted as a central bank, because the United States at that time had no central bank, and he made that fact impossible to miss. The newspapers celebrated him, Congress investigated him, and the political class came away from the experience with a conviction that something had to change. The something that had to change, according to the very people who had profited from the concentration of financial power, was that the United States needed a central bank. In 1908, Congress passed the Aldrich-Vreeland Act, which created a national monetary commission to study the banking systems of Europe and make recommendations for reform. The commission was chaired by Senator Nelson Aldrich of Rhode Island. Aldrich was the Republican Senate leader, and he was also the father-in-law of John D. Rockefeller, Jr. The connection was not subtle. The man tasked with designing the American financial system's future was a direct family member of the most powerful industrial dynasty in the country. Aldrich spent 2 years traveling Europe, studying the Bank of England, the Reichsbank, the Bank of France. He came back convinced that the United States needed a central reserve system modeled on European lines. What he needed was a specific plan, and that is where Jekyll Island comes in. In November of 1910, Senator Nelson Aldrich sent private invitations to 6 men. The invitations were unusual. The recipients were instructed to travel separately to the train station in Hoboken, New Jersey. They were told not to arrive together, not to acknowledge knowing each other if they happened to meet, and to refer to each other only by first names during the journey. They were told they were going on a duck hunting trip. They boarded a private rail car attached to Aldrich's personal train and traveled south to Brunswick, Georgia, where they were taken by boat to Jekyll Island, a private club owned by some of the wealthiest families in America, including the Morgans, the Rockefellers, and the Vanderbilts. The 6 men who made that journey were Nelson Aldrich himself, Abraham Piatt Andrew, the Assistant Secretary of the Treasury, Frank Vanderlip, the President of National City Bank, which was the Rockefeller family bank, Henry Davison, a senior partner at J.P. Morgan and Company, Charles Norton, the President of the First National Bank of New York, and Paul Warburg, a partner at the investment bank Kuhn, Loeb and Company, who had emigrated from Germany and was a member of the Warburg banking dynasty. These 6 men represented, between them, an estimated 1/4 of the total wealth of the entire world. They were not a representative commission. They were not a government body. They were the financial establishment of the United States, gathered in secret to write the rules that would govern American finance for the next century. They spent 9 days at Jekyll Island. When they left, they had a draft of what would become the Federal Reserve Act. The details of the Jekyll Island meeting were kept secret for years. The participants denied it had happened. It was not until 1916 that Frank Vanderlip publicly confirmed the meeting in a Saturday Evening Post article, and not until the 1930s that the full details became widely known. Paul Warburg wrote about it in his memoirs. Nelson Aldrich's biographer confirmed it. The historical record is clear. This is not a conspiracy theory. It is documented history that you can read in primary sources. What was the plan they wrote on Jekyll Island? At its core, it was a design for a central banking system that would be controlled nominally by the government, but operationally by the large private banks. The Federal Reserve, as it was designed, would have 12 regional reserve banks, each technically privately owned by the member banks in their district. The system would be overseen by a Federal Reserve Board in Washington, with some government-appointed members, but the day-to-day operations, the setting of interest rates, the discount window, the management of credit supply, all of this would be in the hands of bankers. The plan went through several versions and considerable political negotiation. When Woodrow Wilson became president in 1912 and the Democrats took control of Congress, the bill that eventually passed was modified from the original Aldrich plan. It gave the government a larger formal role and added the Federal Reserve Board as a stronger oversight body. But the fundamental architecture remained what had been designed at Jekyll Island. The large banks would be members of the system. The system would control the money supply. And the 25,000 independent local banks that had served American communities for generations would be progressively marginalized. The Federal Reserve Act was signed into law by President Wilson on the 23rd of December 1913. Wilson himself later wrote words that suggest he understood what he had done. He wrote that he had unwittingly ruined his country. He wrote that a great industrial nation was now controlled by its system of credit, and that the system of credit was concentrated in private hands. He wrote that the growth of the nation and all of its activities were in the hands of a few men who chilled and checked and destroyed genuine economic freedom. Those words are documented. Wilson wrote them, and then history largely moved on without interrogating them. What happened to the local banks after 1913 is a story that unfolded over decades, not overnight. The Federal Reserve System did not immediately destroy community banking, but it created a structural framework that systematically disadvantaged smaller independent institutions and advantaged the large member banks that had helped design the system. The first mechanism was the reserve requirement structure. Under the Federal Reserve, banks were required to keep reserves with the Fed. The interest rates and terms offered to large member banks were consistently more favorable than the terms available to smaller, non-member institutions. Large banks could borrow from the discount window at preferential rates, giving them a funding cost advantage that smaller banks could not match. The second mechanism was regulatory complexity. As the Federal Reserve System developed, the regulatory requirements for banking became increasingly complex and costly to comply with. A small county bank with 3 employees and a modest loan book did not have the resources to maintain the compliance infrastructure that a large regional or national bank could spread across thousands of employees. Regulation, regardless of its stated purpose, almost always functions as a barrier to entry that entrenches established players against new competitors. The Federal Reserve System created an enormous amount of such regulation, and the established large banks helped write it. The third mechanism was the deliberate manipulation of the money supply. This is where the story becomes most consequential and most contested. In the years following the establishment of the Federal Reserve, the money supply expanded dramatically. Credit was easy. Interest rates were low. Banks lent freely. This fueled the economic boom of the 1920s, the period known as the Roaring Twenties, which looks in retrospect like a classic credit-fueled bubble. Money was cheap, speculation was rampant, and the expansion of credit masked the underlying fragility of the system. Then, beginning in 1928 and accelerating through 1929, the Federal Reserve began contracting the money supply. It raised interest rates. It reduced the availability of credit. The effect on an economy that had become dependent on cheap credit was catastrophic. The stock market crashed in October 1929. Banks called in loans. Borrowers could not repay. Banks failed. Depositors lost savings. The contraction fed on itself. Between 1929 and 1933, approximately 9,000 banks failed in the United States. 9,000 banks. The vast majority of them were small, independent, community banks. The large money center banks in New York, the banks that were at the heart of the Federal Reserve System, survived. Some of them absorbed the assets of failed smaller banks at pennies on the dollar. The consolidation that had been structurally incentivized by the Federal Reserve System was now being completed by the financial catastrophe the system had helped create. Milton Friedman, one of the most celebrated economists of the 20th century and nobody's idea of a radical, concluded after extensive research that the Federal Reserve bore primary responsibility for turning a manageable recession into the Great Depression by allowing and indeed causing the contraction of the money supply. That conclusion is not fringe economics. It is mainstream economic history. Ben Bernanke, who later became chairman of the Federal Reserve himself, said at a dinner honoring Friedman that the Fed had caused the Great Depression and that they would not do it again. But here is the question that Friedman's analysis raises and that mainstream economic history does not adequately pursue. If the Federal Reserve's contraction of the money supply in 1929 to 1933 was such a catastrophic error, who benefited from it? Economic catastrophe does not benefit everyone equally. In a deflationary collapse, those who hold cash and hard assets benefit at the expense of those who hold debt. The banks that survived the Depression acquired the assets of banks that failed at dramatically reduced prices. The wealth of the survivors increased relative to the wealth of everyone else. The consolidation of the banking system that had been underway since 1913 was massively accelerated. By 1935, the American banking system looked nothing like it had in 1910. The 25,000 independent community banks were gone. In their place was a system dominated by a relatively small number of large commercial banks, all of them members of the Federal Reserve System, all of them operating within a regulatory framework that had been largely written by their predecessors and that continued to be shaped by their industry's lobbying apparatus. The families and institutions that had gathered at Jekyll Island in 1910 were among the primary beneficiaries of this transformation. The Rockefeller banking interests, centered on Chase National Bank and later Chase Manhattan, grew into one of the largest financial institutions in the world. The Morgan banking dynasty continued to dominate investment banking through J.P. Morgan and Company, and later through Morgan Stanley and other descendants. The Warburg family's connections to Kuhn, Loeb and Company and the broader international banking network gave them continued influence over the transatlantic flow of capital. This is not a claim that these families conspired to cause the Great Depression. The historical record does not support that specific claim with direct evidence. What the historical record does support is that they designed a system, and that the system operated in ways that consistently concentrated financial power upward toward the institutions that controlled the Federal Reserve, and away from the community banks that had previously distributed that power across the American landscape. There is a concept that comes up repeatedly in the alternative history community, the community that has been exploring questions about suppressed historical knowledge and the deliberate erasure of previous social orders. That concept is the idea of a reset, the notion that a functioning, decentralized, community-oriented system was deliberately dismantled and replaced by a centralized, hierarchical, extractive system, and that the dismantling was obscured by the construction of a false historical narrative about why the change was necessary and inevitable. When you look at what happened to American banking between 1910 and 1935, the reset framework is not a metaphor. It is a description of what literally occurred. A system of 25,000 community banks, each rooted in its local economy, each accountable to its local depositors, each making decisions based on local knowledge, was replaced by a system controlled by a small number of large institutions with their operational headquarters in New York and their regulatory framework written in Washington. The change was not gradual evolution. It was designed at a private meeting on a restricted island, legislated by a Congress many of whose members did not fully understand what they were voting for, and then completed by a financial catastrophe that the new system had helped to cause. The documentation of this process is not hidden. The Jekyll Island meeting is documented in memoirs and congressional records. The Federal Reserve Act is a public document. The bank failure statistics from the Depression are in government archives. The Friedman and Schwartz analysis of the money supply is published economics. What is hidden is not the evidence. What is hidden is the frame. The story is told as a series of necessary reforms, reasonable responses to market failures, prudent modernizations of an antiquated system. The story is not told as what it also was, which is the deliberate redesign of American financial architecture to concentrate power in the hands of the institutions that designed it. Why does this matter in 2024? Because the consolidation that began in 1913 and accelerated through the Depression has continued without interruption. By 2023, the four largest banks in the United States, J.P. Morgan Chase, Bank of America, Wells Fargo, and Citigroup, held assets equivalent to roughly 45% of all bank assets in the country. 4 banks. In 1910, that concentration did not exist because the system was structured to prevent it. The system that replaced it was structured to produce it. The community banks that remain, and there are still some, operate in an environment designed by and for institutions far larger than themselves. The regulatory burden falls disproportionately on small banks because compliance costs are fixed costs, not proportional costs. A $10 billion bank and a $100 million bank face many of the same regulatory requirements, but the $100 million bank is spending a far larger percentage of its revenue on compliance. This structural disadvantage is not accidental. It is the logical outcome of a regulatory system designed by large bank interests over more than a century. There is also the question of what was lost in human terms when the community banking system was dismantled. The local bank was not just a financial institution. It was a piece of local infrastructure, in the same sense that a courthouse or a school was local infrastructure. It embodied local knowledge. The banker who knew your family, who understood your land, who could make a judgment call based on character and history rather than a credit score algorithm, that banker was a piece of social technology that had evolved over generations to serve the specific needs of the communities where it operated. When that banker was replaced by a branch manager following policies written at a corporate headquarters in Charlotte or San Francisco, something was lost that cannot be fully quantified. The small business that might have gotten a loan based on the owner's reputation did not get that loan from the branch of a national bank. The farmer who needed flexibility on repayment terms during a bad year did not get that flexibility from a loan serviced by a company in another state. The economic decisions that had once been made by people with skin in the local game were now being made by people for whom the local outcome was one data point among millions. This is not nostalgia for a system that was perfect. The old local banks had their own failures and their own exclusions. They discriminated, they favored the socially connected, they were sometimes corrupt, but their corruption was local and could be locally addressed. The corruption and dysfunction of a too-big-to-fail national bank is systemic and insulated from local accountability by layers of regulation, corporate structure, and political connection. The phrase too big to fail did not exist in American economic vocabulary before the 20th century. It could not have existed because the structure of the banking system did not allow any individual institution to become so systemically important that its failure would threaten the entire economy. When a county bank failed in 1870, it was a tragedy for its depositors and a setback for the local economy. It was not a global financial crisis. The decentralization of the system was itself a form of systemic risk management. No single point of failure could bring down the whole. The Federal Reserve System replaced that distributed resilience with centralized fragility. By concentrating the financial system around a small number of large institutions and a single central bank, it created exactly the single points of failure it claimed to be eliminating. And then, when those points of failure produced crises in 1929, in 1987, in 2008, the solution offered each time was the same: more centralization, more consolidation, more power to the large institutions that had caused the problem. The 2008 financial crisis is the clearest modern example of this cycle. The crisis was caused by the reckless lending and derivative speculation of the largest financial institutions, the very institutions descended from the banking interests that had designed the Federal Reserve System in 1913. The response to the crisis was to provide those institutions with trillions of dollars in government support, to allow them to absorb smaller banks at distressed prices, and to impose new regulatory frameworks that, predictably, further burdened community banks, while the large institutions hired armies of compliance professionals to navigate them. The four banks that today control 45% of American banking assets were smaller in 2008 than they became as a result of the response to the crisis they caused. If you go back to the primary sources, if you read the congressional debates over the Federal Reserve Act, if you read the dissenting voices who warned in 1913 what this system would become, you find that many of them predicted exactly this outcome. Congressman Charles Lindbergh Sr., the father of the famous aviator, voted against the Federal Reserve Act and said at the time that the act established the most gigantic trust on earth, and that when the president signs that bill, the invisible government of the monetary power will be legalized. He said that from that time forward, depressions will be scientifically created. Those words are in the congressional record. Lindbergh said them on the floor of the House of Representatives in December of 1913. They are not a conspiracy theory. They are the documented prediction of an elected official who had studied the bill and understood what it would do. The question the Tartaria community has been asking with increasing sophistication is not whether powerful interests have shaped the historical record. The evidence that they have is abundant. The question is how deep the reshaping goes and what was present before the reshaping that we have been taught to forget or to dismiss. In the case of American banking, the answer is specific and documentable. What was present before 1913 was a distributed financial system that kept capital circulating at the local level, that gave small communities genuine economic sovereignty, and that structurally prevented the concentration of financial power in a small number of hands. That system was dismantled by the very hands it was preventing from concentrating power, using a process that was designed in secret, sold to the public as reform, and then completed by a financial catastrophe that the new system helped to create. The towns that had those local banks are still there, many of them. Drive through rural Ohio or Kansas or Georgia, and you will still see the old bank buildings on the courthouse squares. Many of them are antique stores now, or insurance offices, or empty. The buildings remain. The institution they housed, the genuinely local financial institution, accountable to the community it served, that is mostly gone. It did not disappear because it failed. It was replaced because it was working, and it was working in a way that distributed power rather than concentrating it. And the people who wanted to concentrate that power had both the motive and, after 1913, the mechanism to accomplish exactly that. The next time someone tells you that the Federal Reserve is a boring technical institution operated by technocrats making neutral economic decisions, ask them about Jekyll Island. Ask them about the 9 men who met in secret in November of 1910 to design the system that governs your access to credit today. Ask them about the 9,000 banks that failed in the Depression and who bought their assets. Ask them about the 4 banks that now control nearly half of all American banking assets and how that concentration came to be. The answers to those questions are in the historical record. They are documented. They are not disputed by serious historians. What is disputed is what those facts mean and whether they were part of a design rather than a series of accidents. When you look at the full arc, from the secret meeting on Jekyll Island in 1910 to the 4-bank domination of American finance today, the word accident becomes very difficult to sustain. The system we have is not the system we always had. The system we always had was replaced, deliberately, by people who understood exactly what they were doing and who benefited enormously from the replacement. That is not a theory. That is what the documents say. And the first step toward understanding where we are is knowing what was here before.